Welcome back to Talk Tickers, your essential guide for navigating the latest earnings calls. Today, we're doing a deep dive into Core & Main's fiscal Q2 2025 results. And this wasn't just another quarterly update, It really sent shares tumbling, and we're here to unpack exactly why.
Yeah, our mission today is really to cut through the noise, the earnings call transcript, the analyst reports. We want to give you, our listener, a really clear understanding of the key takeaways, what's driving things, and what these results actually mean for the company and the market. We'll try to find those crucial insights that help you connect the dots.
All right, let's jump right in. What were the headline numbers that Core & Main delivered for Q2? Give us the quick rundown.
Well, the numbers were, a bit of a mixed bag, which makes the market reaction even more interesting. Their GAAP diluted EPS, that's the official number, came in at 70 cents. That actually missed what analysts were expecting. But, and here's the twist, their non-GAAP adjusted diluted EPS was $0.87.
Okay.
And that beat expectations by roughly $0.87. So better on that adjusted front.
And revenue?
Revenue landed at just under $2.1 billion, $2,093 million to be exact. A slight miss against consensus, but still up. A respectable 6.7% year-over-year increase.
So an adjusted EPS beat, decent revenue growth. But the market reaction was, well, anything but mixed, right? We saw a huge repricing after the call. What drove that?
Huge is definitely the right word. I mean, despite gross profit expanding nicely to $560 million.
Which pushed margins up.
Exactly. Gross margin hit 26.8%. That's a 40 basis point improvement year over year. And adjusted EBITDA grew 3.5% year over year to $266 million. All sounds pretty good. But the market looked right past those positives. It seems the forward-looking guidance was the main culprit.
The guidance.
Yeah.
Always the guidance.
Yep, the stock closed down a staggering 25.4% on the day. And the volume was massive, about 13 times its average. That's not a dip. That's the market's shouting.
Wow, okay. A 25% drop on heavy volume. That definitely signals major concern. So let's peel back the layers. What were the operational realities driving these numbers and that reaction?
Absolutely. And it's interesting because management actually highlighted several areas of strength. They saw healthy municipal demand. The usual repair and replacement of aging water infrastructure.
Right, the stuff that always needs doing.
Exactly. Plus those advanced metering infrastructure conversions, the AMI stuff, upgrading to smart meters, that's a big trend. And new water and wastewater treatment facilities also helped.
Okay, so Muni was solid. What else?
Non-residential was stable. Strong highway and street projects, steady institutional construction like schools and hospitals, and interestingly, real momentum from data centers.
Data centers, that's a bit different for a waterworks company, isn't it?
Well, yes and no. They need massive, reliable water systems for cooling. Core & Main expects data centers to become a bigger piece of their sales mix over time. That's a smart strategic focus. Shows they're pushing into more specialized, high-demand areas.
Interesting. A potential long-term hedge against other cycles, maybe.
That's likely the thinking. Yeah. It requires technical expertise, often higher margins, less tied to, say, the housing market directly. It's definitely a key growth area they're leaning into.
Okay, so some real bright spots, but obviously something went wrong to cause that stock drop. What were the big headwinds? You mentioned one segment in particular.
Yeah, exactly. The big drag was unmistakable softness in residential lot development.
Oh, housing.
Yep. That segment's about 20% of their total sales, so it matters. They saw weakness across the whole quarter, and it apparently continued into August.
Where was that weakness concentrated?
Especially in the sunbelt markets that were growing so fast before. Management pointed straight at higher interest rates, home affordability issues, and just lower consumer confidence. It really hit new home demand hard.
So the housing slowdown really rippled through to them, even though they're infrastructure.
It absolutely did. It reminds you how interconnected things are. That 20% exposure was enough to really worry investors.
Okay, beyond market conditions, costs were also an issue, right? We've heard that theme a lot lately. What happened with their SG&A?
You got it. SG&A expenses, selling, general, and administrative, they jumped 13% year over year to $302 million.
Why such a big jump?
Well, about half of it, maybe $17 million or so, was from integrating recent acquisitions and some one-off timing things. The rest came from volume growth, inflation hitting things like facilities, their fleet, distribution costs, plus strategic investments they're making. But they also flagged an unusual spike in employee benefit costs and higher medical claims. That kind of caught them a bit off guard, it seems.
Ouch, unexpected cost spikes are never fun. So what are they doing about it? Are there cost cuts coming?
Yes, they've already started targeted cost out actions. The goal is better productivity, better operating margins, but without hurting future growth or customer service.
And when do we see the savings?
They expect some benefit in the second half of this fiscal year, fiscal 2025. But the bigger annualized savings will really show up in fiscal 2026. So it's a phased thing.
Okay, makes sense. Let's shift gears slightly. What about growth initiatives? M&A, new locations? Are they still active there?
Oh yeah, definitely still active. Right after the quarter ended, they announced a deal to buy Canada Waterworks.
Canada Waterworks expanding north.
Exactly. It's the 3-branch distributor in Ontario. This gets them into that multi-billion-dollar Canadian market. It's a pretty significant strategic move. And organically, they also opened new locations, Kansas City, Kansas, and Columbus, Wisconsin. So they're still investing in filling out their map, market density, cross-selling opportunities.
How quickly do those new spots pay off?
Typically, they say these greenfield locations break even within about 2 years and then get up to the company average performance in maybe 3 to 5 years. It's a patient approach.
Got it. And what about those higher margin areas you touched on? Private label, specialized projects, are those still performing well?
Yeah, those remain strengths. Their technical expertise, especially in things like treatment plant work and using that fusible HDPE pipe, that continues to help them win market share. Private label products are now about 4% of revenue and still growing steadily.
What about meters? You mentioned AMI earlier.
Right. Meter sales were actually down year over year, but there's context there. They had insane 48% growth last year, so it was a really tough comparison.
Okay, that makes sense.
Plus, there were some project delays. But the good news is they have a growing backlog. Management expects that backlog to start moving in the second half, which should still mean strong full-year growth for meters overall.
Okay, good to hear. And lastly, on the operational side, capital allocation. How did they manage cash flow and the balance sheet?
In Q2, they generated $34 million in operating cash flow. Pretty solid. They spent about $24 million on organic growth, buying back shares, and paying down debt. Year to date, they've bought back $47 million in shares, taking about 1 million shares off the market. And they still have $277 million left on their buyback program.
It's their debt levels.
Net debt leverage is at 2.4 times adjusted EBITDA. That's comfortably within their target range. So the balance sheet looks pretty healthy despite the headwinds.
Okay, so let's connect all these dots now for you, the investor. We need to talk about that revised full-year guidance. As you said, this seemed to be the real trigger for the market's reaction. What exactly did they change?
Yeah, this was the big one. They lowered their full-year 2025 outlook pretty much across the board. Net sales are now expected between $7.6 billion and $7.7 billion. That's down from a prior high estimate of $7.8 billion.
Okay, a trim on the top line. What about profit?
Adjusted EBITDA guidance was cut too. Now $920 million to $940 million. That implies an adjusted EBITDA margin of around 12.1% to 12.2%. Even operating cash flow projections were lowered, now expected between $550 million and $610 million.
Yeah.
So yeah, a clear step down from previous expectations.
What drove that downgrade? Was it just the residential piece, or were other factors playing a big role?
It was mainly those two things we discussed. The definite softening in residential demand and those higher operating costs. Residential lot development is now expected to decline in the low double digits for the full year. That's a pretty significant negative swing.
Wow, low double digits. Okay.
Overall, they now see end market volumes being slightly down for the year. Municipal is still expected to grow low single digits, which is good. Non-residential, roughly flat. And interestingly, they now expect pricing to be basically neutral for the full year. Previously, price increases were helping sales growth.
Right, so that tailwind is gone. No wonder the market reacted. It saw lower volumes, higher costs, and flat pricing. What are the broader implications here?
Well, that guidance cut, especially linking it so clearly to residential weakness and costs, it definitely creates a negative read-through for other companies exposed to housing and maybe some infrastructure names too.
So potentially dragging down sentiment for others.
Potentially, yeah. The market seems to be saying, okay, maybe this residential slump is deeper or longer than we thought. And that fear overshadowed the good parts, like the solid municipal demand, the data center angle, even the good gross margin execution. News headlines immediately jumped on the sales miss and the guidance cut. That fueled the fire for the big share price drop. Management tried to emphasize the long-term positives, but the near-term picture just wasn't pretty enough.
Looking ahead then, what should investors be watching closely? What are the key catalysts or headwinds for Core and Main now?
Okay, key things to watch. First, the timing and actual awards of those municipal projects. We need to see those come through. Second, updates on integrating Canada Waterworks. How smoothly does that go? Third, obviously, any shift in housing affordability or single-family starts. That's crucial for the residential piece.
And their own performance metrics.
Absolutely. The next guidance update with Q3 results will be huge, and keep a close eye on the trajectory of their gross margins. Can they protect those gains? Also, watch the broader sentiment for infrastructure stocks, maybe using an ETF like XLI as a proxy. Look, Core & Main is still consolidating a fragmented market, which is a good long-term story. But right now, the narrative is all about navigating this residential dip without letting margins slide too much.
Okay, great summary. Now, for our favorite part of Talk Tickers, the outrageous but plausible trade idea for your imaginary investment committee. And remember, everyone, this is purely for fun, entertainment, definitely not financial advice.
All right, so you've got this massive market reaction, right? A 25% haircut in one day. And it seems almost entirely due to a cyclical slowdown in housing and some, frankly, manageable operational cost issues. Meanwhile, the big picture, the long-term secular drivers for water infrastructure, aging pipes, population growth, tougher regulations, that stuff hasn't changed at all.
Okay, so you're seeing a disconnect, a potential overreaction.
Exactly, a big overreaction, potentially. So the pitch is a cyclical rebound equity call ladder.
A call ladder. Okay, break that down.
It involves buying an in-the-money call option on Core & Main, ticker CNM. Let's say with a December 2026 expiry, giving it time to play out, maybe pick a strike price like $50, something reflecting a decent recovery from current levels.
Okay, so a bullish bet with time.
Right. But then, to reduce the cost, you simultaneously sell 2 further out-of-the-money calls with the same December 2026 expiry. Perhaps strikes at $65 and $75.
Ah, so you collect premium from selling those higher calls to help pay for the one you bought.
Precisely. It lowers your upfront cost, gives you that bullish exposure, but caps your maximum profit potential around that $75 mark, defining your risk. You're basically leveraging the value created by the market sell-off. You're betting that residential will find its footing, structural demand will reassert itself, and C&M will climb back towards, maybe even past its old highs. The core bet is simple. The market panicked about short-term cyclical stuff and ignored the strong long-term story and the company's solid execution elsewhere.
Interesting structure. Okay, let's wrap up our deep dive into Core & Main's Q2. What's the single biggest takeaway you want listeners to hold on to?
I'd say Core & Main showed good operational chops, especially on gross margin. But the market fixated entirely on the lowered full-year guidance, which was driven by that residential softness and higher costs. That guidance cut just completely dominated the narrative and led to that huge share price drop, overshadowing the underlying strengths.
Operational positives overshadowed by near-term guidance headwinds. Got it. And as always, please remember, this discussion is purely for informational purposes. It is absolutely not investment advice. Always do your own thorough research and due diligence.
Definitely. And maybe here's a final thought for you to chew on as you do that research. If Core & Main's fundamental business is consolidating this essential fragmented water infrastructure market, a market with real long-term tailwinds, how much is that long-term value really damaged by what might just be a temporary dip in residential development? Did the market get this right? Or is this a classic case of overreacting to near-term news, potentially creating a long-term opportunity? Something to think about. Until next time, keep those financial gears turning. Thank you for tuning in to Talk Tickers.